Emma thought she had found the perfect finance app. Beautiful design, thousands of 5-star reviews, millions of users. Even celebrities promoted it. Then one notification made her ask a question almost nobody thinks about. Who actually has my money? The answer changed how she uses every finance app she owns. Emma is 27. She's a graphic designer. She just started earning good money for the first time in her life, and she wants to do something smart with it. So she does what everyone does now. She opens the App Store and starts downloading. An influencer she follows keeps talking about a new app. Her friend swears by it too. This app gives 5% rewards, her friend says. It's basically free money. Emma signs up in under 2 minutes. No paperwork, no branch visit, just her phone number and a selfie. The app feels incredible. Smooth animations, confetti when she gets paid, little badges for hitting savings goals, a cashback wheel she can spin every morning, push notifications that cheer her on like a friend. It doesn't feel like banking. It feels like a game she's winning. 3 weeks later, Emma is 1 day away from paying rent. She opens the app to move money to her landlord's account. Instead of the usual smooth transfer screen, she sees a message she's never seen before. Your account is temporarily restricted while we complete a routine review. No transfer button, no explanation, just a support chatbot that says a human agent will respond within 24 to 48 hours. Emma refreshes the app 4 times in 10 minutes. She emails support. She calls the number listed. 36 hours pass before an actual person replies, and even then, the reply is a form message asking her to upload a photo ID and a selfie for verification purposes. Rent is due tomorrow. Her money is sitting inside an app she can't reach, with only a vague note about fraud prevention and no timeline for when it will end. That's when she asks the question for the first time. If this company isn't a bank, then who is actually holding her money, and why can one message freeze all of it? She starts reading. Not gossip, not forum posts, just the app's own website, and she learns something most users never bother to check. Many popular finance apps like Chime and Cash App are not banks at all. They are financial technology companies. Chime's own site states clearly that banking services are provided by partner banks. Cash App is operated by Block, and the money moves through a partner bank as well. The sleek app on Emma's phone is really just the front door. The actual vault is somewhere else, run by an FDIC-insured bank most users have never heard of. This isn't a scandal. It's just how the industry is built. But it means the beautiful app and the institution actually holding the money are 2 different things. And it also explains what just happened to Emma. Fraud prevention reviews and identity checks are standard practice across these apps, published right there in their help centers. They exist to protect users from stolen accounts. But it also means access to your own money can pause without warning, sometimes for days, exactly when you need it most.
Emma manages to borrow rent money from a friend that night. The next morning, her account unlocks. The account was restored after the verification process. Emma still wished she had known this could happen before relying on the app for rent. But something in her has changed. She starts treating every app on her phone like it deserves an interview, not blind trust. She opens Chime first and actually reads the fine print this time. She learns that her balance is FDIC insured through its partner bank, up to the standard coverage limit, the same protection a traditional bank offers. Then she opens Robinhood. She assumes it works the same way. It doesn't. Robinhood is a brokerage account, not a bank account. Her stocks and cash sitting there for investing are protected by SIPC instead of FDIC, the Securities Investor Protection Corporation, which protects against the brokerage itself failing, not against her investments losing value. Robinhood states this distinction openly in its own disclosures. It was never hidden. She just never looked before. Emma opens PayPal next, curious where her balance actually sits. She finds that PayPal's own terms explain how funds in a PayPal balance are held, and that certain balances can also be FDIC insured through partner banks, depending on the product and country. Again, all documented, never advertised loudly.
Then she opens Wise. She had used it once to send money to a cousin abroad. She reads Wise's help pages and learns it operates as a money transfer service with its own regulatory licenses in the countries it operates in, structured differently again from a savings app or a brokerage. 3 apps, 3 completely different legal structures. Same phone, same Emma. She never knew. She keeps going. She reads through a terms of service page and finds an arbitration clause. It says that if she ever has a serious dispute with the company, she generally can't take them to court in front of a jury. Instead, she has to go through private arbitration. This isn't unique to one app. It's standard across huge parts of the fintech and banking industry, written into agreements from companies both large and small. It's legal, it's disclosed. She just never read it until an account freeze made her feel exactly how much power that fine print holds. Emma isn't scared anymore, though. She's curious. She starts asking a new question every time she opens an app. Who is the partner bank? What happens if the app itself gets acquired or shuts down? Could her money get frozen again during a routine review? She finds that Revolut, Wise, and PayPal all publish some version of a policy on account holds and reviews. It's usually framed around fraud prevention, but now she reads it as a warning label, not just legal language. She thinks about her phone getting lost or stolen. Could someone drain her account? She checks each app's security page. 2-factor authentication, device recognition, biometric locks, all documented, all available, but none of them were switched on by default in every app. A setting that exists isn't the same as a setting that's active, and Emma had never bothered to turn most of them on until now.
Not every app on Emma's phone works the same way either. She also uses Google Pay and Phone Pay every day, mostly to pay her building's watchman or split a dinner bill. She realizes these apps mainly facilitate UPI payments and connect straight to her existing bank account, rather than holding a large standalone balance the way Chime or Cash App might. That's an important difference. Before assuming any app offers the same protection, Emma now checks what type of app it actually is: a payment app that passes money through her real bank, or a fintech app that holds a balance, invests it, or lends against it. Somewhere in all this reading, Emma opens her reward summary and smiles. 800 rupees in cash back over 3 months. Not bad, she thinks. Then, out of habit now, she checks the fee schedule on the same app. Instant withdrawal fees, a monthly subscription plan for the premium tier that unlocks better rewards, a foreign transaction markup buried a few screens deep. She compares it with another app that gives smaller rewards but no subscription and no withdrawal fee. The 800 rupees suddenly doesn't look quite as impressive when she adds up what she paid to earn it. Nothing about it is hidden exactly. It's all listed in writing in the fee schedule. She just never used to read that far. Now she checks the cost of a reward before she gets excited about it. 1 year later, Emma still uses 5 different finance apps on her phone, but she's not the same user who signed up for confetti and cash back wheels. Now she knows exactly which app she trusts with 500 rupees for splitting a coffee bill, which one she trusts with her serious emergency fund because she's checked its FDIC-insured partner bank and its holds policy, and which one she only uses for quick payments through her existing bank, nothing more. She keeps her long-term savings spread across more than one place, because one frozen notification taught her that convenience and safety aren't always the same thing.
Emma still likes the rewards. She still likes the clean design. But before she moves serious money anywhere, she checks one simple thing. Is this a bank account backed by FDIC insurance through a partner bank? An investment account backed by SIPC? A licensed money transfer service? Or just a payment app connected to her real bank? She reads the actual terms, at least the sections on holds, fees, and disputes, and she turns on every security feature the app offers, instead of assuming it's automatic. Here's what she'd want you to remember. Check who actually holds your money, the app or the partner bank behind it. Read the key terms before depositing large amounts, especially anything about holds, fees, and disputes. Understand exactly what protects your money: FDIC for bank deposits, SIPC for investment accounts, and know the difference. Don't confuse a slick app with a licensed, chartered bank. They are often not the same thing. Know which apps are just payment tools connected to your bank, and which ones actually hold your balance. Don't let rewards, streaks, or bonuses influence where your serious savings go. Keep your emergency fund diversified, instead of concentrated in one app. Look past the cashback number
and check the actual fee schedule before a reward impresses you. Technology is changing how we manage money, but the smartest investors don't trust beautiful apps. They trust what those apps actually promise in writing. If this video helped you see money differently, please like, comment, subscribe, and support Finance First Steps, because the best investment you'll ever make is understanding how money really works.